Edge Designations, CAIA Level 1, Topic 2, Introduction to Alternative Investments, Reading 2.1, What is an Alternative Investment? On the first page over here, you can see all the learning objectives that are required. We produce those for you there on page 1. Those continue onwards onto page 2. Let's get ourselves going straight away onto page 3, where we start the content. Reading 2.1, What is an Alternative Investment? The first learning objective, learning outcome 2.11, demonstrate knowledge of various alternative investment types. Okay, and we start off over here and a little bit of an introduction in terms of what is, first and foremost, before we move towards alternative investments, what is an investment? An investment is defined as foregoing current consumption in favor of expected future benefits. In other words, not to consume today, but in the benefit and the hope that you'll get benefits from that at a later point in time. Generally speaking, and this is the way we're going to look at alternatives as we move through the CAIA Level 1 syllabus, okay, is we always are going to be comparing alternative investments, which is obviously why we're all here for CAIA, to traditional investments. Traditional investments, when we speak of those, we're typically talking about equities and fixed income securities. Why are they called traditional? Well, they've been around, and that was the traditional way to invest. You typically went into equities or into fixed income. Okay, how does alternative investments differ from traditional? Okay, the types of investments that are made are different. Fee structures for alternative investments will differ, and typically speaking, the fees are higher for alternative investments structures than they are for traditional. They pay incentive fees based on performance, alternative investments, and generally speaking, they've got low return correlations with traditional investments, which typically is a good thing if one were thinking of adding them to a portfolio of traditional investments. They are less liquid than traditional investments in stocks and bonds. They are less regulated and less transparent. We're not necessarily saying that any of these things are good things or bad things. These are just their characteristics of alternatives. They generally have less available historical and volatility data, and they've typically got different legal and tax treatments than do traditionals. Looking at institutional quality investments, okay, these are investments that are acceptable, as we say, for institutions to invest in. And that's why you often found that the institutions went more for the stocks and bonds, because those were more suited towards institutions. Those are the ones that were acceptable to them. We are now moving across to try and get the institutions excited and investing in alternatives as well. Institutional quality alternative investments fall into the following 4 categories. Okay, and when we have a look over here at the various categories that we're speaking of, okay, look at how the breakdown looks. Okay, and what you notice first and foremost, and I'm talking for those that have perhaps been in the system for a while, okay, what you'll notice over here when we do the breakdown of alternative investments, you'll notice in the past we had an investment, one of the alternative investment categories called structured products. You'll notice that's not here anymore. Okay, and what's happened with structured products, it's found its way into the various other alternative asset investment classes, predominantly into private debt. But the 3 that have always been there were real assets, hedge funds, and private equity. Structured products has now been replaced by a much more popular alternative investment class called private debt. And a lot of structured products, in fact, finds their way into private debt as well. Okay, if you look at where the growth has been and where the fall off in growth has been, typically speaking, if you look at hedge funds over there, okay, quite a sharp decline in hedge funds over the years, from 40% down to 24%. Private equity nicely up, and private debt up as well there as well. Real assets, a small fall off, but nothing too much over there. I'm not going to spend too much time over here, guys, when we look at the various types of alternative asset and alternative asset investment classes. Reason being, of course, is we will see these in great detail in their particular sections. Remember, of course, guys, that there is a specific topic for each and every one of the major alternative investment asset classes. Hedge funds, okay, generally speaking, there's no real definition of hedge funds, and they make use of both long and short positions. Long means to buy, short means to sell. A key characteristic of hedge funds as well is the use of leverage. Leverage just means debt. Okay. And we'll discuss that much more when we get to hedge funds. Private debt. Okay. We've got various categories within private debt. Okay. Direct lending, lending money directly. Okay. Distressed investing, investing in companies that in their debt when that company is not in a good way. It's a distressed company, and obviously hoping that the company does better and that distressed debt then becomes valuable. Mezzanine debt, a form of debt financing that's got certain features in it. Often they've got conversion features which will allow the holder to convert their debt into equity, and we'll talk about those much more again in their respective places. And you notice over here, that's what I spoke about a bit earlier, structured products. Structured products used to be viewed, and I'm going back to 2023 and years before that, structured products used to be viewed as a separate alternative asset investment class. Now it finds its way under a private debt. Okay, things over here, structured products, things like CDOs, collateralized mortgage obligations, collateralized debt obligations, CDSs, credit default swaps, and we'll talk about all of those in the correct place. You've got private equity as well as a separate alternative asset investment class, things like buyout companies, leverage buyouts, LBOs, MBOs, management buyouts. We've got venture capital as well. We'll talk about all of those as we go. A brief look at some of those. Private equity strategies are generally leverage buyouts. When you look at the word leverage, means they make use of extensive amounts of debt in order to make their purchases. Okay, generally be able to affect a successful leverage buyout. The company that you buy generally needs to have strong cash flows. Why strong cash flows? So that they can fund the huge amounts of debt that have been taken on in order to pay the interest and cash on the debt. MBO is very similar to an LBO, but it's a situation when management are involved. In other words, who are the people buying out the company? The existing management team. And you can get an MBI, a management buy-in, when you bring in an external management team to replace the current team. You've also got venture capital. Venture capital is, generally speaking, we talk about it as being very early stage investment in companies. Most of these are not successful. Those that are successful are highly successful, and obviously you make your money then on those. The last alternative asset investment class, real assets. Okay, and the word, exactly what the word says, real assets. These are investments in actual assets. We'll talk about things like operationally focused real assets. Okay, that they're not just an asset that sits idle, it needs to be worked. Things like real estate, infrastructure, IP, intellectual property. And we've got an entire topic number 3, which will deal with real assets. We'll talk about real estate as a investment class. We'll speak about both residential and commercial properties. Other real assets we spend a bit of time on. Timberland is where revenue is generated from the sale of timber. Farmland is where revenue is generated from the sale of agricultural products. You've also got infrastructure investments, and these are investments in large projects, things like hospitals, roads, schools, etc. Okay. You've got financial assets such as investments in intellectual property, these are typically what we would call intangible investments, things like copyrights, patents, things like that. Natural resources, okay, mineral assets, things like that. Commodities as well. We'll spend a bit of time on commodities, things like metals, energy products, agricultural products, etc. Over our page, top of page 6, we look over here, learning objectives 2.1.2. demonstrate knowledge of the defining characteristics of alternative investments. And we have touched on this a little bit earlier on, but let's take a look again. Remember, we are always going to be breaking down our alternative assets into the 4 major groupings: hedge funds, private equity, private debt, and real assets in there as well. When we look over here, talking about hedge funds, okay, we talk about liquid alternative mutual funds, okay, that would provide a bit more liquidity. On the private equity side, you generally got closed-end funds, they are illiquid. Real estate, public real estate, okay, and on the private debt side, you've got BDCs. We'll talk a lot more about those. BDCs are what we call business development corporations, and okay, public real estate investment trust, which is a REIT. Okay, when we talk about if you're looking at a traditional only investment on the hedge funds, mutual funds, private equity, what would compare to private equity on the traditional side? Public equity, in other words, equity that is traded on a public exchange. Real assets, okay, public equity with management making key decisions, and high yield bonds would be a similar traditional only investment when you're comparing on the private debt side. Okay, several times they can be alternative or traditional, and sometimes when we make the comparisons, we compare to traditional only. Okay, and as you can see from the above table, similar investment types of investments can either go under alternative, okay, or traditional, okay, and sometimes they can go under traditional only, okay, depending on where their investment sits. So you can see there's a nice we work across different investments, and it's often it's not correct to be able to look at alternative investments and say there's no link at all between alternative investments and the traditionals. Often they move across each other, as you can see over there in the table. Learning objective 213, demonstrate knowledge of the history of alternative investments in the US. Okay, and just a word now that we are here. Okay, a lot of guys will say, oh, history of alternative investments, what a bore. Okay, first of all, it is interesting. Okay, number 2 is just keep in mind the way CAIA likes to examine. CAIA is very specific, remembering again, of course, guys, that a large component of your CAIA exam is going to be, okay, theory, when you talk about theory or qualitative data, as opposed, of course, to the quantitative calculation based. The majority of our exam is on the theory side. They do like to ask us, so you need to know this. Okay, in the early 50s, MPT, modern portfolio theory, was established. 80s and 90s, we started to look at investments more as opposed to individual, but more on a portfolio basis. The 80s saw an introduction of what we call small capitalization stocks, low quality corporate bonds, okay, without being disrespectful, but we're not going to call them junk bonds, but a similar nature, and alternative investments were introduced into portfolios. Okay, often these assets on a standalone didn't have reliable sources of income and weren't regarded as being overly secure. But when we added these particular investments then to a portfolio as a result of certain benefits, particularly diversification benefits, and remember, diversification benefits, guys, when we look at that, what do we always say? That when there is low levels of correlation between the assets in a portfolio, and typically we always say there are low, generally we say there are low levels of correlation between alternative assets and traditional assets. Therefore, to add them to a portfolio will bring about a very good diversification benefits. Top of page 7, the following table gives us details of the more commonly used investments, at least on an institutional level. Look at that, 1890 till 1920, more government debt, real estate mortgages, preferred stock. 1920 to 950, what did we add into the investment, overall investment picture? Okay, high quality corporate bonds, domestic equities, agricultural debt. 1950 to 1980, we started to introduce average quality, not just high quality, but average quality corporate bonds and global or international equities. 1980 till 2010, high yield debt, okay, small cap stocks, structured product, private equity, real assets, and hedge funds. Hedge funds really came into their being early on in the 80s and grew exponentially. They've had a lower investment, as we saw on the first page of the first set of notes, where we saw that hedge funds are falling off a little bit in terms of the overall picture. But 1980 to 2010, they were predominant. 2010 till now, we've added in private debt, okay, growth equity, infrastructure, and digital assets. And of course, you can see over there that some of the key things we are going to be talking about as we move through the CAIA syllabus is in the 2010 to present space. Topic 7, as a standalone, we've got an entire topic which we didn't have in the past on digital assets, okay, and private debt, of course, now is seen as a separate infrastructure, as a separate alternative investment. Let's go. Learning objective 214, demonstrate knowledge of the history of alternative investments in Asia. Okay, and if we go back in the past, Asia preferred investing in real assets. Okay, and based on that, investments in cash, currencies, and real estate. Okay, okay, for centuries, cash as an asset class always had a store of value based on the underlying metal used to produce it. Okay, real estate was based also on the underlying asset, which was land as well. And most of the trade done in Asia was without the use of central banks, legal tender, or exchange. Okay, and based on that, there was very little usage of fixed income securities. Post World War II, several Asian countries received sovereignty. Okay, when they received their sovereignty, they formed their own stock exchanges, retirement management, central banks, financial regulators, etc., to support the institutional framework. As a result, several family-managed businesses listed their entities on the stock exchange, which then made a vibrant stock exchange, paved the way for mutual funds and collective investment vehicles, and generally speaking, now you had a much more diversified market in Asia. Having said all of that, in Asia, the promoters still hold large shares in their investments. Okay, for example, you look at India, 40% of India's public market cap is held by promoter groups. Now remember, if there's too much of a company or an exchange of shares being held by one large group, that of course limits the depth, the volume, and the scale thereof. Japan is Asia's leader in private equity investments. Okay, Asia's institutional hedge fund industry goes back to the 90s and has grown substantially since then, from a market of $10 billion assets under management to $300 billion today. Talking about private debt and venture debt. Remember, venture debt as a term is just the other side of venture capital. That's when early stage investors come into the business. They don't invest in the business in terms of equity, they loan debt. They put debt into the business. That's called venture debt. Okay, and that's also growing there in Asia. Real estate, it's still a major investment class as it always was in Asia. Okay, and it's broken down into its major categories: retail, residential, commercial, warehousing, industrial, and hospitality. There we go. Over our page, top of page 8. Okay, demonstrate knowledge of how alternatives and traditional investments are distinguished by their return characteristics. And we look at the various characteristics then of alternative investments. Number 1 is this level of illiquidity. For the most part, alternative investments are relatively illiquid when we compare them to traditional. Okay, we talk about a concept called a lumpy asset. A lumpy asset is an asset that's very difficult to divide up. Okay, and you can't trade it in small, manageable quantities. It trades only in certain quantities. We look at diversification. They generally, and we said that alternative assets are good diversifiers when they are added to traditional investments. Okay, because they've got low levels of correlations. An absolute return product, okay, is a product that has no or low levels of correlation with a traditional investment, and of course is then a very good source of diversification. Inefficiency, generally speaking, the old traditional market stocks and bonds were a lot more efficient, An inefficient market is where there's a price difference between the price expected in an efficient market, okay, and that's typically what we have for a large part for the alternative asset space. Non-normality, what is non-normality? Non-normality, okay, is normally what we would expect, and we're going to see this in topic 2. We like a nice normal distribution or symmetrical distribution of returns, okay, and it follows the normal, as I'm sure people are aware. We'll just draw the picture for you, okay. There's your normal distribution, the mean is in the middle, okay. Most of the observations are over there. We've got a little bit sitting there in the tail, but nothing to write home about. Whereas non-normal distributions is what we typically see when we work with alternative investments, okay, and we will deal with that in its correct place in topic 2. We also talk a little bit here about trading structure and security structure. Generally speaking, there are low trading volumes with alternative investments as opposed to traditionals, and they trade quite infrequently. Obviously, that will result in prices and returns not being worked out and calculated on a daily basis. Generally, that's done on a longer term basis. In terms of the security structure, the non-linear payoff, okay, as well as the use, particularly when we look at hedge funds, an extensive use of leverage, debt, okay, and derivatives as well, will give a bit of a non-linear nature to the returns, okay, particularly when you deal with things like derivatives. Okay. Top of page 9, demonstrate knowledge of how alternative and traditional investments are distinguished by methods of analysis. So we start off with our very first one, okay, method of analysis. We talk about return computation models, okay, and a return computation model takes into account that due to the trading structures of alternatives, there's often not enough information available for each alternative investment, and we make use of other measures. A very commonly used measure, particularly around the private equity space, is the internal rate of return method, okay, which uses the timing of the cash flows as opposed to the price and other such data. We will talk a lot more about internal rates of return as we go forward. Statistical methods. Alternative investments, as we know, exhibit non-normal returns as opposed to the normal distribution. And based on that, if it were just working with a normal distribution, the mean and the standard deviation would probably be sufficient to explain the returns. But alternative investments don't work with normal distributions, and then we need to incorporate new measures like skewness and leptokurtosis. If those terms sound a bit strange and foreign to you, don't stress. Those will come up again in topic number 2 in great detail. We talk about valuation methods with respect to traditionals versus alternatives. And traditionally, okay, you could either use fundamental or technical analysis when looking at valuation. Alternative investments have got issues with respect to those methodologies, and they need to use things like transaction-based prices. Appraisal-based valuation is when I use an expert, an appraiser, to do my valuation. Typically, you'll find that around real estate. The unique cash flow characteristics of alternatives make valuation a bit more challenging. And the short-term nature of some alternatives, okay, for example, if you're trying to, some hedge funds take advantage of pricing discrepancies called arbitrage, will make that a challenge as well. Portfolio management methods, okay, the problem with the typical portfolio management methodology is they rely on efficient pricing. Alternatives generally have inefficient pricing, illiquidity, and non-normal returns, which makes, okay, using any kind of a traditional methodology and portfolio management method quite difficult then to use. Okay, and of course we'll see as we go forward, alternative investors make use of specific methodologies. Top of page 10, demonstrate knowledge of other characteristics that distinguish alternative investments from traditionals. Okay, well, let's have a look at some of those. Regulatory factors. Generally, the traditionals are more regulated than are the alternatives. Security structures. Generally, when you're working with alternative investments, you can get some quite elaborate structures, like for mortgage-backed securities, things like that. We will handle those in their space. Trading strategies, okay, generally speaking, okay, not much room available in alternative asset space for passive strategies. Most of those are generally quite active, okay, generally speaking, like hedge funds, private equity structures, okay, as opposed to the traditional space where there's a big market now for passive structures and strategies. Compensation structures, we spoke about this a little bit earlier. Generally speaking, your compensation structures are quite high for alternative investments. Okay, and we'll talk about that again when we get to their particular section. Institutional structures. This structure looks at how markets and financial institutions affect ownership and trading of an investment, publicly versus privately traded. We'll look at that. Information asymmetry. Now, if you look at this word, interesting word, information asymmetry. Now, it's important to remember, okay, asymmetry means that not equal. Okay, so if we talk about over here with information asymmetry, okay, it's when you've got a particular market, okay, and the different market participants have got access to different levels of information regarding that investment, regarding the market, regarding that particular investment. And that's often the case, particularly if you get something like an alternative investment like real estate. Not everybody knows the same thing about the particular product and if the property, and in fact there's probably not a lot known about the property in and of itself. Top of page 11, we talk about incomplete markets. Okay, an incomplete market is where we've got limited opportunity to satisfy the investment options of the market participants. Okay, for example, we've got this concept, and we'll deal with this much more as well. Moral hazard. Moral hazard, for example, is when people behave differently. Because we talk about it when we talk about an insurance market. For example, if a person has got an insurance contract on their motor, on their car, okay, they are likely to behave in a different way than a guy that does not have insurance on his car. The guy with insurance on his car is not overly worried where he leaves the car, or even if it's perhaps locked or not locked, because he knows that if it unfortunately does get stolen, insurance will come to the picture. Not so for someone that is not insured. So often people might not want to invest in certain companies, okay, based on this particular concept. Okay, we also mention moral hazard over here when we talk about banks. How does moral hazard relate to banks? Okay, remember that, for example, when you invest in a bank, we've got what we call FDIC. FDIC is the Federal Deposit Insurance. Okay, that what happens with that is that in the event of your money at the bank, run on the bank, and the bank can't guarantee that money, there is insurance on your funds. So what does that lend people then to do? People start to invest in banks that are not so, it doesn't really matter if the bank is a strong bank or not a strong bank, because it doesn't matter if that bank fails because your money is insured. So you typically go with the bank that gives you the highest rate. Okay. We look a bit at innovation. Alternative investments tend to innovate more rapidly than traditional investments. Okay. Every investment, both traditional and alternative, is impacted in the way what we've spoken about, all the various structures. We've mentioned 8 of them up there. Okay. Learning objective 218, demonstrate knowledge of the goals of alternative investing. We talk about passive versus active investing. Passive investors, generally we know about passive investing, they don't change their investment holdings as a result of new investment expectations. They're passive. They hold that investment across the period. Okay, that's often referred to as indexing. Okay, they match a benchmark and they keep to that investment over the period of time. Okay, active managers, okay, generally are trying to, and that's where you get the concept of alpha. Active managers they look at the benchmark and they try and beat or outperform that particular benchmark. Okay, passive management, as we know, has gained a lot of popularity over time, but we say that active management is still the approach according to which the overwhelming majority of equity assets are managed. I know some people might argue with that, but that is what our textbook tells us. Okay, active return is the portfolio's return. Okay. And why is it called active return? Because you set a benchmark. Let's just say, for example, your benchmark is 5%, the S&P 500 is our benchmark. Say, for example, it achieved 5%. If I've managed to achieve 15%, well, then my active return, we call it AR, active return, will be what I achieved, the 15% less what the benchmark achieved, and that'll be my active return will then be the 10%. Okay. What we do in terms of our calculations over here, and we're going to see this calculation come up many times as we go forward, particularly into topic number 2, that we take active return, we just showed you that over there, that's your return or your alpha return over active risk. That's called the information ratio. We've got absolute versus relative returns. Absolute returns are the actual return itself. So if I just take you back over here, my absolute return will be the 15%. Okay. Relative return is what's my return relative to something else, relative to a benchmark. That'll be the 10% over there. We talk about some interesting concepts further here. Okay. Arbitrage, return enhancers, return diversifiers. Arbitrage in its purest form is risk-free profits. Okay, and again, that'll come up many times again as we progress. A return enhancer is an investment that aims to enhance portfolio returns. A return diversifier, its aim is not there to enhance returns, but its aim there is to diversify the portfolio. We've spoken about this. How do we diversify a portfolio? We add investments to the portfolio that are less correlated with the investments that are currently in the portfolio, and that'll bring about diversification benefits. 2.19, demonstrate knowledge of the 2 pillars of alternative investment management. Okay, we talk about when making an investment decision, we make use of 2 pillars, empirical and economic reasoning. Empirical analysis, okay, is past performance is generally used to predict and assess for future performance. Okay, it's always important to remember that the past is not a clear indicator of future returns. Empirical methods therefore tend to be less reliable when being used to explain alternative asset returns as opposed to when they're being used for traditional. Generally, traditional investments may have a better pattern than would alternative investments when trying to predict a future. Economic reasoning, okay. Remember, we spoke about historical analysis. So you say, well, what happened in the past and how will that impact what happens in the future? Okay, and we said the downside of that is that past returns are not necessarily clear indicators of future returns. Economic reasoning then comes about and says, let's do a bit of a sanity check. And exactly that. Economic reasoning says, is there solid economic or underlying theory for our particular assets so that we should invest in that particular asset? Okay. When adding a new alternative investment to an already well-diversified portfolio, we make use of both empirical and economic reasoning. Empirical is what's happened in the past, and as well as economic reasoning. Okay. Our investment goal is achieved with a balance between the 2 pillars, evidence based upon objective analysis and empirical proven data, and evidence based on our assessment of economic theories based on sound reasoning. Okay. When looking at alternative investments via a 2x2 framework, okay, we've got primary goal, okay, we've got our trading characteristics, okay. If your primary goal is return enhancement and you want to do so with more public type of assets, hedge funds would be your investment. If you want return enhanced, if your primary goal is to enhance your returns, but you want to do so with private assets, the best thing you could use is private equity or private credit. If your goal is risk management and you want to do so with public assets, structured products, in other words, you can structure a product to meet your specific requirements. If you want to manage risk and you want to do so on a private basis, real assets might well be your objective. Okay. Whenever you see these over here in your notes, guys, typical exam question, what that is, that's an exam question from a past CAIA practice paper. Should give you a bit of an indication then of what you can expect, okay, in your exam. A lot of guys say, well, maybe that's not what's going to be in the exam. just understand what it is. Typically, the question is a past CAIA practice question. Top of page 14, you've got your edge checkers over there. These are just tests that you understood what went on in the particular reading 2.1. They continue onwards onto page 15, and then on page 16, you see over there, you get your solutions to the edge checker. To take a look at those, make sure you're getting all of those right, and they continue onwards then onto page 17. Okay, that then brings us to a conclusion of reading 2.1. What is an alternative investment?